So today we are going to cover harmonics, ratios, and support and resistance. And it's only fair if I acknowledge the main author of this kind of strategy, that is Damien Castilla. He's a full-time trader, although he really focuses on futures. But much of this I actually learned from Damien Castilla. So it's only fair to acknowledge his work, because it's basically his main author. But it's a strategy. I found it working so well, and it works across the markets, across our various instruments. Can work in forex, futures, and indices, and probably also in stocks. So we go now into details about harmonics, market structure, and ratios, and how they play together. So we say harmonics is the process of identifying the market rhythm or its pulse, if you will, and exploiting any and all opportunities. Many times when you look at the market, people say there's so much noise in the market because you just see it moving up and down. At times there's no direction. So many people just see the noise. The noise the price chart is making, by just swinging up and down, but you cannot really give them any message. But when you identify how the market speaks to you and the language you understand, then you realize there's some consistency in the way the price moves, and you can actually follow and forecast for you to be able to enter good trades. So there are visual occurrences that have tendencies to repeat themselves over and over again. So we are saying, because as we focus on the price movement, price is what we look at. So we'll just use the price charts. And you're saying the price as it prints on the chart, there are some occurrences that have tendencies to repeat themselves. And because they repeat themselves, we're able to forecast when is it likely to occur again, at what level, so that now we come up with our area of interest. We go ahead of the price because we expect it to behave like this in the future as time goes on. So we're able to identify our area of interest, wait for the market to reach there, then we enter our entries, and also be able to determine our stop loss position and our take profit positions based on the chart reading, what the market is speaking to us. So it is our job as chart technicians to identify those occurrences, which repeat themselves, and we trade them. And the principles of harmonics and ratios have no boundaries. Just as we've said, they can be applied to any instrument or time frame. Again, from the beginning, we said whatever we are learning here can apply actually in all the instruments and all time frames. And that means even the time, if time comes, we want to transition from forex to indices or forex to futures, then you can still use the same strategy. Again, you're also saying, depending on the time you have, your screen time, the strategy also applies in all time frames. You can use it in 5-minute time frame, or 15 minutes, or 1 hour, or even a day. The daily charts. So it doesn't have any limitation. So you go deep to market structure, and you want to find out what is market structure, right? And you're saying structure analysis is the foundation to proper chart reading. So basically it tells us what gives us the patterns which are repeating themselves for us to be able to use them to forecast what is the next pattern to print and where am I supposed to enter my trade, so that I wait for the market there. And again, we say those are our areas of interest once we identify them. So it is also by far the most neglected component to technical analysis among traders. So market structure is how the chart speaks to us, technical analysts, and lets us know with very high degree of probability where it wants to go next. It is our job to pick up on these clues to properly and accurately forecast where the market is heading. Right? So remember, we said in forex there is nothing guaranteed. All right? But you only look at the opportunities that we have a higher probability of the market playing out according to our expectations, so that now we're able to make good use of that and make some good profit out of that. So we only take higher probability trades. And high probability trades are those which have high risk-reward ratio, to mean the risk you are taking is worth given the profit you're expecting. All right? So we look for the higher probability trades which are likely to give us good results compared to the risk we are taking in that trade. And market structure is much more than horizontal lines that indicate support or resistance, or on a more complex level areas of supply and demand. So we are saying, remember when you're discussing support and resistance, we say they are not just lines, but they are zones. Yeah, they are zones. We have support zone, resistance zones, and supply and demand zones. Okay, so you're saying it's actually more than that. So performing proper and meaningful structure analysis, it details the proper identification of certain structural landmarks, the relevance of those landmarks, and the proper expectation that derives from the combination of these three components. Okay, so there are things you're going to look at. What are those landmarks, which I need to see it, which I am able to identify and to expect it to print again over and over again, and which also helps me to make form an expectation and wait for the market to play as according to my expectation. Okay, so it's actually not so different from what we had done earlier about our uptrending market going high and high, yeah, and the downtrending market. So it's just confirming and affirming what we saw in our uptrending markets and downtrending markets. So we are going to look at a chart to see how we do structure analysis. Okay, you can see that. So if you can see that chart clearly, and I'm hoping you can see it clearly, but I'll also go to the platform and try to draw such. You can see the topmost we have what we call NS high, right? So if you remember, in an uptrending market, we said the highs get higher and the lows get higher. Uptrending market, the highs get higher. So like HH, the highs get higher and the lows get higher. So now those highs which get higher, when it comes now that in terms of market structure or structural analysis, we say when there is the first high, we can call it H1. The next high, which is higher than the previous high, we call it new structure high. New structure high. Okay. So given on our market analysis, now every successive high, which is higher than the previous one, we call it a new structure high. Okay. And from one high to from low to high, that we call it a swing. Okay. Allow me to just use this. I want to use from here. This is green. I hope you can see. I printed a green line. Kindly just try and see, because you saw you cannot change the color of the lines or my pointer. So we are looking at that, that area. This is a low and this is a high. Okay. So from this low to this high, we call this a swing. Okay. This one is a swing. A swing. Okay. So from low to high, it's a swing. So the market retraces, forms a higher low. Okay. When it forms a higher low, because this is an uptrending market, so we expect when it resumes to form a higher high, which is now called a new structure high, because it is higher than the previous high with in our market structure. So every successive high, which is higher than the previous high, we call it a new structure high. Okay. So as long as an uptrending market, our expectation is that the market will continue to print every time it resumes uptrend, it prints a new structure high, it retraces, gives us a higher low, then it resumes and prints another new structure high. Okay, so that is our expectation. We have a new structure high here, the market retraces, gives us a new higher low because it's uptrending market. Then it resumes uptrend, gives us another new structure high, which is higher than this one. Okay, so you can see from one high to another, they are going higher and higher. So that's why it is a new structure high. Okay, so whatever we were previously saying a higher high, now it becomes, it's what we are calling a new structure high. Okay, then it retraces, forms a higher low, and then it goes and it forms another new structure high, okay, which is this one here. Now, from this level, the market has retraced, but it has gone way below the previous higher low, okay? So the market has formed a lower low, okay? Because we were seeing every low was higher than the previous low. That's why we have a higher low here, and another higher low here. So our expectation was like, after the market prints this new structure high, it should retrace and form another higher low around here. But it breached our expectation, or rather we say that expectation has failed because the market has gone past the previous low and it has printed a lower low, which now we are calling a new structure low. Okay, it's a new structure low. And remember, when we say in our downtrending market, the lows are lower, the lows are lower than the previous low. Okay, it prints a lower low. So this market has now printed a lower low because this was the previous low, okay, but now we have another new low. So the first new lower low becomes our new structure low. New structure low, because we said in downtrending market, the lows get lower and the highs get lower, okay? Lower lows and lower highs, okay? So just to use this other side of the market to illustrate that, let me clear everything. So when the market now prints this new structure, we can assume this market now it is somewhere here now, starting around here, okay? So it has printed a new structure low because it is lower than the previous low. It has already breached our expectation, okay? So from here now we expect the market to be downtrending because it's already adopting characteristics of a downtrending market by printing lower lows, which is lower than the previous low. So now our expectation has changed. Previously, we were expecting new structure high, higher low, another one new structure high, and a higher low. But now it has printed a lower low. Our expectation has changed because now the market is already displaying characteristics of a downtrending market, okay? So now, after printing this new structure low, because now the market is now becoming a downtrending market, we expect a lower high, okay? In this case, we have here a lower high, okay? It's a lower high because in downtrending market, we have lower highs, okay? So from here, the market resumes a downtrend, prints a lower low, which again we say that is becoming our new structure low. So every succeeding, is it succeeding, preceding? Yes, succeeding. A low, it becomes a new structure low, as long as it is lower than the previous low, okay? So we have new structure low 1, new structure low 2, it retraces, it forms another lower high because it is lower than the previous high, okay? It prints a lower high, then it resumes a downtrend, and it prints a new structure low, okay? If you remember, we said in an uptrending market, because it's uptrending, bulls are running the market, we look for opportunities to buy, okay? And we buy at the lows to make good use of, to get a good opportunity of getting good profits, okay? So we buy at the lows. So if the market is uptrending, starting from where we started from, and the market goes from lower, okay, this one just assume it's a new structure high, it's coming like this because it is already now changing direction here. So the moment the market shows that it's now resuming to an uptrending market, or rather reverse to an uptrending market, now we look for opportunity to enter, and we will enter here based on our analysis. And in our analysis now we are going to use the Fibonacci retracements, okay, Fibonacci retracements. So that will help us to form now we know the market is uptrending, it has to retrace. So as we get deeper, we are going to see. So how deep, or rather, how do we form an expectation as to how deep the market will get for us to wait for it, yeah, where we expect it to come to, right? Or rather, where to identify our area of interest, okay? So if it's an uptrending market, we buy at the lows. We'll buy here, the market moves up, retraces, we can buy here, the market resumes an uptrend, goes up, forms a new structure high, it comes down, forms another higher low, we can buy here. So we buy at the lows. For uptrending market, we buy at the higher lows, okay? Not where we have the new structure highs. Same case to downtrending market. We sell, and we sell at the highs. For downtrending market, we sell at the highs, which is the best price possible for us, so that we able to, when the market goes down, we liquidate and we pocket our profit. So we will sell here, we can sell here, yeah, until the market, we see the structure has been broken, all right? And then the structure has been broken. So we'll go to a platform to identify those moves in our chart to see how we can identify them. And again, let's also say it is vital to have and trade with expectations, as they keep you in line with the strength of the market, as well as with proper order flow. Yeah, we are going to analyze further about order flow. So we are saying when it's uptrending market, always buy. Our expectation is that the market will always form new structure high. That remains until it is breached, and it was breached here. So until we get such a scenario where the low is lower than the previous low, our expectation remains. Market will always print a new structure high, give us a higher low, form another new structure high, and that continues until that expectation fails or the structure is broken, right? And this is how like in our case, the structure was broken, okay? So these basic expectations of structure analysis alone will help you forecast with a very high degree of accuracy where the market intends to move to, or rather to move next to, okay? So within the main swing, we have other small swings. Just allow me to get you to my screen. We're going to share screen. We look at this on the price chart and see how we can identify such swings, how we draw them. Allow me to clear what I think I should have deleted earlier so that we start with you from scratch for you to get it better. So now, like in this case, the market printed this was a high and this was a low, okay? So from the high, for a downtrending market, from the high to the low, we call it a swing, all right? So this we call it a swing. We can call it our swing one, From the high to the low, that's a swing, okay? Then the market retraces. So this was our high, Let's see if we can see how the market was. Actually, the market was downtrending. So here it formed a new structure low here, right? So we are going to say this is because it was downtrending, new structure low, okay? Because this low, it's lower than the previous low here, all right? So our expectation was for the market to retrace, which it did. It retraced and gave us a lower high, all right? Lower high, and it is lower compared to this high here. So because now these are downtrending markets, so it will continue printing lower lows, which are our new structure lows. It retraces, forms a lower high because it is lower than the previous high. So our next expectation is for the market to print another new structure low, which is lower than the previous one, and it did. Okay. Then here we have a new structure low. Okay. The market has printed a new structure low. Then we expect it to retrace, and it should retrace somewhere lower than the previous low. This was our previous high, which was lower than the previous one. So the retracement here should be, we should get a lower high than the previous one. But we notice the market retraced and it went back to the same line with the previous lower high. Okay. So in such a case, we see the market has retested. It has done a retest of the previous high, okay? But that already gives you a message, okay? And the market has retraced so deep. It gives you a message. It shows you the bulls are really coming in. The bulls are fighting, okay? The bulls are really fighting. So already that tells you, although our expectation is a new structure low, but that kind of a retracement, it's already a signal that this market, the bulls are coming in, and the market likely to reverse back to a bullish market. Okay, but we'll also see more details about how to measure, what to expect when it comes to retracement. Okay, but now we are saying this is not really a lower high per se, because it is on the same line with the previous high. So it's a retest of the previous high because they're on the same line. But still expect the market to form a new structure high. It can still form a new structure high. But you notice the market now retraces just something so small, and then it goes up. It goes up to this level. Now the market has breached the principles of a downtrending market, because the principles of a downtrending market is that the highs get lower, but now it has gotten higher than the previous, the two of them. So now whatever it has formed is the new structure high. Okay, now we have a new structure high. Okay, the moment it breaches, because it's already now showing us it's an uptrending market. We are already seeing it has formed a higher previous than the other highs. Already now as adopting the characteristics of an uptrending market. So from there we expect a higher low. Okay, and the market gives us a higher low, which is that one. Okay, so we will call this one a higher low. Sorry, it is a higher low compared to the previous low here. Okay, so this long line here from the new structure low, this one to the other new structure high. Let me change the color so that you can see it clearly. I will give it yellow. That yellow line, it forms our new swing. Okay, it forms our new swing and that's our main swing for an uptrending market. Okay, so from here our expectation has changed, and now we expect the market to print a new structure high. It has given us a higher low, so the next move is a new structure high, which it actually does. All right, it gives us a new structure high, and again our expectation stands, and we wait for it to. We have a new structure high. Okay, then from there we expect the market to retrace, form another higher low, then it continues and gives us another new structure high. Okay, another new structure high. So that is how we form expectations. Yeah, until the expectation fails or the structure is broken, you have to stick to your expectations. Yeah, but there are moments that expectation weakens. All right, like our case here. The moment the market retraces from this new structure low to this lower high, which retested the previous lower high, already the expectation was weakening. because you're seeing the bulls have been able to push the market so high, and now we are not having a lower high, we are having a retest of the previous lower high. And because expectation weakened, the next move, now the structure was broken, or now our expectation failed, right? So now so when you see the expectation weakening, we will not change expectation, but you'll be careful before you enter a trade. Okay, you'll be careful before you enter a trade. Like in this case, when this one was a test, so you need to be careful that this market may not make, already it may not make a new structure low. Although that is still our expectation, but it is weakening because the bulls are coming in and they have pushed the market much far deeper or much higher than what we expected. All right. And when you have already the expectation is weakening, already we are seeing now the structure has been broken, and now the market has assumed an uptrending market. So these are the swings, yeah. But also have swings within a swing, smaller swings within a swing. Okay. So in this case, if we are buying for an uptrending market, we will buy here. We will also buy here, okay? Because it's an uptrending market, all right? We'll buy there. We are now using our main swings, but again, we also have a smaller swings within a swing. So you can decide whether to trade the main swing or the smaller swings. Like in this case, here, this is a smaller swing here, the one in the red is our main swing. But now we only let's look at the side, the line, the right side of our red line, our red long line, okay, this one. So you look on the right side, okay? So the yellow ones are forming the main swing, okay? From high low to new structure high. But in between, yeah, like the first one, from this new structure low, we have the red ones are forming a minor swing, okay? Like the first swing, we have a minor swing. Actually, let me make it a little bit more clearer, sorry. Yeah, so that is where our main swing. So the yellow lines forms the main swing, and the red ones are forming the minor swings, okay? Minor swings. But you can see the minor swings are also inclined to the main swing, okay? So you can decide just a way to work on the main swing only, the yellow lines, yeah? Or you trade the minor swings, okay? If it was the minor swings, you can enter here. For the minor swing, you can enter there. You can also enter there, okay? If you are trading the minor swings, you should try as much as possible to ensure you trade in line with the main swing. Don't try to sell in there at the highs there. Always let it retrace, because even if you try your Fibonacci to, it will still give retracements for the minor swings. You can see the first one retraced up to 50, okay? So you still, even if you trade the minor swings, you use the same analysis like when you're trading the main swing, all right? So we have so you can decide whether to trade the main swing or the minor swings. All of them, they work the same, but only trade the minor swing if it is aligned with the main swing. Sometimes the minor swing can actually, the main swing can actually be like a downtrading. In areas where we say we have a complex correction, you find the minor swing, the swing within the main swing, it's actually moving in a downward direction. You can say take a risk and you trade in a downward direction, okay? But you have to be extremely careful because you are trading against expectation, yeah? Because if the expectation is structure high and you're selling, then you have to be ready for any occur or any eventuality in case the market knocks you out at a loss, it's because you're trading against expectation. Okay, so but we'll see in what scenarios can we do such a case where you can trade against expectation and you think you're still within your rules, all right, and you're ready for whatever occurs. So that's it about the main swings, and then you have the new structure lows and the new structure highs, unless there's a question before I move from here. So basically what has changed, the higher highs have changed to new structure highs, and the lower lows have changed to new structure lows. This remains, but now it's only the terms which have changed as we get deeper and get more specific to our analysis, because as I mentioned, this now forms the core of our analysis. Yeah, and you're going to see that as we proceed. So if there is no any other question, we go back to the chart and see what else we can cover within the ratios and harmonics. So basically that is a structure analysis, yeah, discovering, forming expectations based on the flow of the market and trading within the expectations, and then noticing when the expectation is weakening, try to see what can you make out of that, and when the expectation changes or when the structure is broken, then you change your expectation and you trade as the market speaks to you. So that's how the market is speaking to us, okay? As it forms new structure lows one after another, it is telling us continue selling. That's what the market is speaking to us. So we have to wait for it to retraces to a lower high, then we sell, all right? Great. So we go to what we call order flow analysis, and this is still within structural analysis. And we say order flow analysis goes hand in hand with structure analysis and helps you to gauge the strength or weakness of the price swings, okay? So we can achieve this by observing and comparing the three components that determine strength and weakness from swing to swing in any market, all right? So we're still building up on our structure analysis to see how can we tell the market is weakening. Yeah, as it goes down, can we say the bears are losing power and the bulls are coming in? For us to be prepared, not to be caught unawares. Also, for us to look for the reversal of patterns, yeah? Like actually when you look at this particular one, this is a very clear head and shoulder. Can you see that? We have the left shoulder, head, and a right shoulder, and a neckline. You can see that where we said the lower high retested the previous lower high, that's the neckline. So when you see the market is weakening, you can start now, you know, what do I expect? Yeah, because it is weakening, it means the bulls are coming in. So if I also see the market print a reversal pattern, so to be a confirmation the market is reversed, even before it gives me that new structure high, I'm already prepared for a buy if it gives me a signal at the right position. So it just helps you to think ahead of the market and wait for it to confirm the thoughts, to confirm your expectation. Then once you enter within your expectation and wait for the market to play as per your expectations. Okay, so we are in under order flow analysis. We are going to see how can you tell that the market is weakening or strengthening. The bulls are getting stronger or the bears are getting stronger, whichever way, depending on the direction of the trend, whether it's uptrending or downtrending. So we have said that there are three components which help us to analyze whether the market is weakening or strengthening. So these components, when analyzed properly, gives the technician, yeah, that is the technical analyst, me and you, a huge advantage in determining whether a trend is strengthening, weakening, or if a reversal is imminent. The most important element of this analysis, and the one overlooked the most, is its ability to provide extremely accurate expectations as to where these cycle highs and lows are likely to occur, right? Because remember we said, if it is a downtrending market, we sell at the highs. So we're able to form an expectation. When is the next high? Where is the next high going to print? so that we expect to sell there. That becomes our area of interest. Wait for the market that it reaches there, it gives a signal, you sell. Okay. So this becomes even more powerful when the use of bar by bar analysis, that we'll also look at that later, and Fibonacci studies, when they are combined. So below are the components of order flow analysis and the expectations we have from them. So we said we have three components which we use, which also print on our chart, which help us to form an expectation. We can tell whether the market is strengthening using these components or the market is weakening, and then we see whether our expectation holds, whether it is strong enough or our expectation is weakening, and whether we should buy or we should wait for the market to confirm what we think is right, or rather our thoughts. So the first of those components is called projection. And you see, projection is the distance a new structure high or new structure low makes from the previous new structure high or new structure low. So remember, for an uptrending market, we say it forms a new structure high, it retraces, forms another new structure high higher than the previous one. So that distance between the successive new structure highs, that is the projection, or the distance between two new structure lows, the first and the second. That is our projection. Okay. So the expectation from projection is that the stronger or the longer the projection, the more strength behind price, and the shorter or weaker the expected corrections. So we are saying if the distance between two new structure highs is big, it tells you the market is very strong. The market is, the bulls are really in charge, and it's a strong bullish market. So I'm going to repeat that. The expectation from projection is that the stronger or longer the projection, the more strength behind price, and the shorter or weaker the expected correction. So if that distance between the two new structure highs is big, it means the market is very strong. And then when it comes to reversing, it means it will not reverse very deep. Retracement will just be something shorter, which means we expect it to come just in between 38 or between 38 and 50% Fibonacci ratios. That's how we form expectation. So you've done your measurements, you look at your projection, it's getting longer and longer. So as it gets longer, so when the market is retracing, we expect the market to make a shallow correction. And the shallow correction is something in between 38.2% to 50%. In between there is shallow correction, okay? But if that distance is very small, the projection is small, the distance between the new structure high and the other new structure high is very small, it means the market is weakening. So we expect, remember it's a new structure high to new structure high, so the bulls are in charge. But when that distance is becoming smaller, it means the bears are fighting, they are resisting, they are pushing, they're trying to refuse the bulls from pushing the market up. So it means the bears are coming in. So we expect the market to correct deeper, to have a deeper correction, which means between 61 to 76 or somewhere above 50%. Okay, because the bears are coming in, so they're pushing the market deeper. That is why the bulls are unable to make a very big projection, because they're not able to move to make a very high, bigger new structure high, a bigger distance, because they're already facing some fight, some resistance from the bears. So it's already telling you the bears are coming in. As you buy, be careful. Be careful. These guys can also take control and reverse the market. All right. Hope you've gotten it. But you're also going to see in our price chart how we can identify that. Then we go to momentum, okay? And you say momentum is the pitch or the angle of the swings in comparison to each other. Remember, these ones, you don't look at them in isolation. You just try to check compared to the previous one. Just the projection before the one you're at now. There is the current one. Momentum, look at the current one compared to the previous one. So momentum is the pitch or the angle of the swings. You remember the swings, from there, like for a downtrending market, from the lower high to the new structure low, those swings. So the pitch, how slanting are they? How, how sharp are they? Okay, as you compare with the previous swing. So steeper angles in comparison to the previous swing are an indication of strength building. So the steeper the momentum, the stronger the market is. Okay, because it also means the opponents are not strong enough. So if it's a bullish market and we see the momentum is getting steeper and steeper, it means the bulls are running the market without any much resistance, and you'll find maybe several bullish candles without a single bearish candlestick, right? That's why they get steeper, because there are no bearish candles, there is no resistance, there is no fight. They're able to just make very steep, very maybe long bullish candles, or several bullish, like 3 following each other without any resistance, without any space in between them. So it makes them steeper, which tells you the market is building strength, or rather the bulls are very strong. And the opposite is true. If there is decline in pitch, as this signifies weakening in price, okay, or rather in price action. So we'll also look at depth, so that now when we go to our chart, we look at all of them at once. Depth is all about the pullback, correction, or the retracement. It is the distance from a new structure high or a new structure low to the corrective swing high or low, depending. So deep depth in price action indicates weakening of the driving force, while shallow depth indicates strength. Just as we said, if you remember when you are analyzing our market, when the market was downtrending, we saw our lower high, it was equal to the previous lower high. Where is it at a retest? So it retraced too deep. And we said when you see such a scenario, it means the bears are coming in. The bulls are coming in, sorry. And they are likely to reverse the market from a bear to a bullish direction. Okay? So we can look at all of them in one chart. You can see that. So we can look at, this is a downtrending market, so the bears are in control. So we have the H1, the highest point there, and then from that to the new structure low 1, that is the momentum, the pitch, the angle. So we say if it is too steep compared to the previous one, it means that the bears are very strong, considering this downtrending market, And then we said the retracement is the depth. You can see the depth one, that is the depth. If it is too deep, it means there's a lot of force. There are bulls coming in. That's why they're able to push the market so much deep. So the longer the depth, the weakening the market is to the direction of the trend. Okay. Then between new structure low to the next new structure low, that is the projection. Okay. We can see, if we can just start from the beginning, the market moved from H1, formed a new structure low 1, which I called it 1. It retraced to H2, which is our lower high, because it's lower than the previous one. Then it resumed its original trend of a downtrending market, printed a new structure low, our new structure low 2. Then it retraced, forming our depth number 2, okay, from the H3, which our lower high number 3, and then it resumed again. So when you look at this market, let's start with projection. So we have projection 1. You can see that is quite bigger compared to projection 2. We said projection is the distance between new structure low to the next new structure low. And you can see that is quite big. To tell us the bears are in control. It's a strong bearish market, all right? When you look at projection 2, you can see this distance is very small compared to the previous one. Already when you see such kind of a scenario, expect 2 things. Either the market likely to reverse and become bullish, or you expect a deeper correction. And again, we said deeper correction is any correction above 50%. Could be 61 or 76%, all right? So that helps you to know, where do I wait for the market? Because with this kind of a change from projection 1 to projection 2, there is no way you can wait for your market at 38%. No way, right? Because you're expecting a deeper correction. We say these three components help us to form expectations, and then you trade as per your expectations and wait for the market to play out as per your expectation. So it's using these components you're able to analyze and know, so where am I going to wait? Because my aim is to enter as profitable trade. So I look for opportunities to enter my trade. But where do I enter my trade? If it is a selling, where am I going to sell? We said for sell, we sell at the highs, okay? So I have to wait for this market to retrace, make a high, then I sell at the high, okay? So when I look at projection number 2, it tells me this market is weakening. So I expect two things. Either the market may reverse altogether, become bullish, or make a deep correction. So because the main expectation of a new structural low remains, I wait for a deep correction. So if I must sell, I will not sell until this market reaches 61. You just say, I will set 61, nothing less than that, okay? If I miss out on the trade, well and good. If the market retraces to 38 and decide to resume the original trade of downtrending and I miss out an entry, well and good. You'd rather miss out than enter too early, only for the market to reverse, and then you enter a loss. As we say, the first priority is to protect your trade. Sorry, to protect your capital. Protect your capital. Not more of the profit, protecting your capital. Okay. So you'd rather miss out a trade than you enter too early, only for the market not to play out. So from this kind of projection, given projection 1, projection 2, then this tells us this market is, the bears are weakening. So you need to be careful if you're going to sell. And if you must sell, only sell when the market has made a deeper correction to somewhere between 61 and 76. All right. So that's it with projection. Then you look at, remember we look at all of them, not just one of them. So our projection tells us the bears are weakening. What about momentum? Momentum is the pitch, yeah? How slanting. The steeper it is, the stronger the market is, all right? It's not really about the length as per se, but how steep is it? But when we look at our momentum, actually they are parallel. None is steeper than the other. From the way they look, yeah? They look almost, no, none is stronger than the other. So it is just, it's not telling us anything. We leave it. Then we look at depth, okay? And depth we say we look at how deep is it, okay? So if the market retraces very deep, it tells us it is weakening. The price is weakening, all right? So you look at depth 1, it was very shallow, all right? Then depth 2, it is a little bit deeper compared to depth 1. But more than that, it's also very straight. It's like just a clear bullish candles without a single bearish candle in between. Already that also communicates something to us. Yeah, although it's not very deep, but the way it is just like a straight vertical line, telling us it is just like a clear bullish candlesticks without any interruption of a bear in between. Which also tells us an area where bulls are waiting for the market. Bulls are around here. So already we have 2 out of 3 telling us the market is weakening. The bulls are coming in. They are refusing the bears to push the market down. So when those 2 out of 3, it gives us a stronger probability that our expectation is right. This market is weakening, so expect a deeper correction or a reversal. So you wait for the market. If it retraces to 61, no signal, do not sell, let it go. If it goes to 76, no signal, let it go. Don't sell. Just wait until the market gives another opportunity, most likely to bear, because the chances are this market is going to reverse. All right? So we've seen that those 3. So you have to look at those 3 and then make a decision based on what they are telling you, what they are communicating to you. All right? So to go to, we are saying this is the analysis we focus on to identify breakdown in price swings and address turning points or market reversals. Okay, because we said like in this case you can see projection 2 is smaller than projection 1. All right, and depth 2, although it's still a little bit deeper than depth 1, but also the way it is, yeah, it is just like a straight vertical line which means it's a just line of bulls without a single bear coming in. So that tells us the bulls are, this most likely it's a demand zone. The bulls are waiting here, all right, and they are entering around that area. It also helps us determine, based on expectations, areas of interest for possible entries on either continuations or reversal opportunities. Okay, so basically that's what we've said. So these are the three key components you use to tell the strength of the market and how you're going to trade. All right. So before we go to supply and demand, we will go to our chart, the main chart. That's MT4 platform. Try to identify all these components and we see how we can trade them. All right, we see how they play out on the main chart. So I will share my screen so that we can go through that with you. Just try to clean up my chart so that I do everything from the scratch with you for you to see how we do this. That was H1. Actually, this is the chart I've shared, we've just discussed. We drew this with the morning team, and you can see the market actually going up and up. When the projection was so small, or the market is still not making up, it has not yet made a new structural low. Although this is H1, it may take time to form, but altogether, you can see the market is just going up and up, all right? Or you can see it also it has formed a very deep correction. It's already at past 76. Sorry, past 61, in between 61 and 76. So when it touches 76, you can still enter, you can still sell once the market gives you a signal, because again we said our expectation still remains until this H3 is broken or the previous lower high is broken. Expectation still stands, right? So let's look for any other market to do our analysis. We can look at this. This is Euro USD 5-minute chart. Don't bother about the candlesticks. Yeah, when we need to see which candlestick it was, we're going to zoom in. For now, we just want to look at the structure and the order flow. Okay. So in this case, this market formed. We just start slightly this side. Yeah? So we had lower high there. We had a lower high here. I think I do it in red so that you can see clearly. The lines can be the other colors. The market formed a new structure low. Okay. We have new structure low forming there. Then the market retraced. So we have a swing. That's one of our main swing. Okay. The market retraced. It formed a another lower high, lower than the previous one. So when we look at this market, No, I still need another item. To form a new structure low. Okay. So this becomes our main swing. Let's say we have come in at this level. We just come to our screen and found the market there. When it's forming the new structure low, it's about to reverse, or it's about to retrace. So now we need to form an expectation. The market is there right now. We need to form an expectation, okay? So we are saying when you look at the projection, projection looks good. It's quite big. There's a lot of force there, all right? Then we look at the momentum, all right? Momentum, this is steeper. It shows also the bears are still strong. They look at the depth. This depth does, okay, from that alone, it shows that the bears are very strong, okay? So we can still look for opportunity to, oh, sorry, when I enlarge, because it's good to see the type of candles which printed. Well, let's just continue on this other side of the market, because that one we need to enlarge and see. It's what you call the bar by bar analysis. You have to see the type of candlesticks that are printed, so that can be able, because my feeling is at the bottom here, yes, I've gone to still that one, it still highs. You see, even before we do that, you can see after this new structure law was formed, there was a very strong rejection. And the market is on H1. But even when you're looking at M5, it just that the price has really moved from that region. We cannot really see that area using the smaller time frames, especially when we have enlarged our candlesticks. Okay, so let's just look at the bullish side of it. It will still give us better results, good results. So I will use the 18 for us to be able to capture good moves. So we'll start from the very bottom. The market formed a new structure low. It was downtrending, which is okay. It was expected. Yeah. But the previous high was where? This is where we had our lower high. Okay. It was there. The market made a very good move, formed a new structure low. But already looking at this tails also tell a lot. We can see here there are bulls idly coming in, price is being rejected here. So, but we still wait. We still follow our three components. So, given this kind of move, this kind of momentum, we expect a shallow correction. Yeah. I can draw the other momentum. This was the previous momentum. No, it was not from there. That was the previous momentum. No, it was not even from there, because this is not a new. The previous momentum was sometimes you print everything, I forget to unhighlight. Actually, if I enlarge, it gives me more than we will be able to analyze when you have enlarged the candlesticks. Let's just work from here. That's our lower high. So the market retraced. It retraced up to where? with our Fibonacci. When the market is here, we just opened your machine and you found the market there at the new structure low. So our expectation was for another new structure low. The market to retrace and make a new structure low. But when the market retraced from here, although it made a high, but it made a retest of the previous high. Okay? Trying to be sure I don't delete anything. So this is our new lower high. And you can see it's in line with the previous one. They are on the same line. Yeah, as you can see, on the same line. So that delta alone tells us the market the strength is weakening. The market is weakening, the bears are weakening because the bulls have been able to push the market to attain the same lower height like the previous one. Okay, so already there is breakdown of structure. So here the expectation is with that kind of a deep correction, the market is likely to reverse, and actually the market reverses. So when you see such a deeper correction, although the expectation remains for a new structure low, but that expectation is weakening, so you're better off not even trading it. So we joined the market when it was here. Now it has formed I will remove this vertical line so that we can see. Oh, sorry, I delete things not be highlighted. We joined the market where the new structure low is. Now we've watched the market. It has printed a lower high, which is on the same line with the previous lower high. Okay, so our expectation is weakening. Then the market starts resuming the original trend. It reaches there and you see it struggling. Now already we say this expectation is weakening. So anything is possible. Reversal is almost happening. And then you see the market formed at inverse head and shoulder. Okay, can you see that? The market formed an inverse head and shoulder. This thing never draws my inverse head and shoulder nicely. I don't know why the Euro USD refuses. Or what am I picking? Oh, triangle, sorry. So it is the problem is not the machine. Yeah, even after marking it has refused. You can see that. Because when I do that, just print it. Triangle. From there to there to there. It's refused. Anyway, you can see this was our left shoulder. I have to do it the longer way, sorry. That was our left shoulder. Then our head formed from new structure low to the next lower high, which was in line with the previous one. And then we got a right shoulder. So at this level, because we already formed an expectation, with that kind of depth, this market is likely to reversal. So you can actually take a risk and say, so I'm looking for opportunity to buy. All right? Start scanning through the chart. What more can the chart tell me? First of all, at the very bottom here where it printed the new structure low, the market was so much, the tail is long. The market, there was so much rejection. The bulls are coming in, all right? So if there's a possibility, the market is reversing. And actually, instead of printing a new structure low, it just comes here and it prints a higher high, which is a new structure high, okay? It prints a new structure high. You see there? So now the market has broken structure. It was a downtrending market, but we saw the signal when it retraced so deep, retesting the previous low high. Already the expectation was weakening, but before it breaks through, before it goes past the lower high, still the expectation remains. Only that it's weakening, and it only fails the moment the market breaks through the previous lower high and prints a higher high, which is our new structure high. So in this case, now the new structure low to the new structure high forms our new main swing. Okay, so right now that becomes our main swing. That blue color, that is not our main swing. The smaller ones are the minor swings. Yeah? So now we are looking for opportunity to buy, because the moment the market prints a higher high, it's already adopting characteristics of a uptrending market. All right, so we change expectation, we start looking for opportunity to buy, because we expect the market to retrace, form a higher low. It forms a higher low, then it resumes the original move. Okay, so this is our higher low. Then the market resumes and prints a new structure high. New structure high. Okay, so you've seen already, you're seeing these components help us make some decisions. Okay, so we can still use these two swings, these two smaller swings. That is from new structure low to this lower high, and then this more retracement, to help us make a decision concerning at what point are we going to buy. Okay, so when we look at this momentum from the new structure, sorry, I'm going to change again the colors so that we can this I'll put it in yellow so that we can differentiate the minor swing and the main swing. Can you see the yellow line? It is too steep, that's why you cannot even see it. But I can still move it just a little bit outside for you to see it. That's the yellow line. That's a minor swing. This one I will just move it away from there. And I draw another. So that's our momentum. And you look at that momentum, it is so steep. It's just like a straight standing line. And when you see just besides it, there's no single bearish candle in between it, between the new structure low and the lower high. Yeah, so that just, the momentum is so strong. It is so steep, it's almost like a vertical line. So that tells us the bulls are so strong. All right, so we expect a shallow correction. Okay, no wonder the market formed head and shoulder. Okay, and we said for a shallow correction it should only come not anything past 50. All right, and it's exactly at 50. Shallow correction should go beyond 50. Deeper correction should be above 50, between 50 and 76. But more often, when I expect a shallow correction, I look at between 61 and 76. Not anything less than 61. Unless I get a stronger signal at 50. Okay? So shallow correction between 38 and 50. So that one, it came up to 50. So that's a shallow correction. Again, our expectation is playing out. All right? And then the market forms a new structure. So for now, because we've done the Fibonacci, I will delete the Fibonacci ratio. The chart to be a little bit clear. I don't delete anything else important. All right, so it made a shallow correction and then it printed a new structure. Sorry, it printed a new structure high. Okay, new structure high. Again, we also see the depth is sorry, the momentum is also very steep here. Okay, we can also measure, although we don't have a preceding one, but that's okay. We can just what we have, the depth and the momentum. Okay, so we continue. So that's how you make your analysis. When to expect a deeper correction, it helps to know where to wait for the market. Okay, and also when the market corrects deeper, We also expect, as the market is weakening, we expect a weaker new structure high, right? Let me see if I can get such a scenario. This market, from here, it retraced, because we draw Fibonacci from the low to high. From this new structure high, the second structure high, it retraced way past 76. So when the market makes a deeper correction, we expect a weaker new structure high. By weaker new structure high, it means the projection will be it's getting shorter. It should be getting shorter and shorter. Should be getting shorter and shorter, and that helps us to know where to place our take profit. Okay, because after this new structure high, the market retraced to 76. So it means the market is weakening. So we expect a weaker new structure high. So if I buy here, there is no way I'll place my take profit somewhere around here. Okay, somewhere here. My things are not picking. I cannot put it anywhere around here. Okay, because I expect a weaker new structure high. So in such a case, when the market corrects deeper, you're like 76 or 61, your take profit should be at 127.2. And you can see when the market printed a new structure high here, new structure high, very shallow, because with a deep correction, we also say that it means the market is weakening. So we also expect either reverse or a weaker new structure high. Okay, so we have, this is our new projection. Hope you're getting all this. It just the same things, like going round and round in circles, which they are all confirming the same thing. All right, so this is our new projection. So this is our projection number 1, and compare it with projection number 2. Or rather, this is projection number 2 compared to the projection number 1, the first one. So look at that distance. Okay. So when the market retraced shallowly, when it retraced to around 50 or thereabout, the projection was longer. So in that way, it moved to extension 138. 138. When it made a shallow correction, the market also gave us a stronger projection. So we were able to take our take profit far. But when it gave us a deeper correction, it retraced deeper, we also expect, because it means the market is weakening, the bulls are weakening. So they may not make a very high new structure high. So we expect a smaller projection. And no wonder the market just hit at 127, it reversed. Okay? So all these things work all together. They confirm each other. Okay? Deeper correction tells us expect a shallow projection. Shallow projection tells us expect a deeper correction. Okay, so wherever you've come in, where you found the market, you're able to already analyze and know, so what am I expecting as concerning the next structure high, or the next correction, or the projection, or the depth. Yeah, remember the depth is correction. So if you're expecting a deeper depth, or rather a deeper correction, so it means once it reaches there, so also expect after that one is achieved, expect a weaker new structure high, which will mean expect a shallow projection. When you get a shallow projection, now expect a deeper. So when they follow each other like that, almost reverse what is meant. Okay, the market is weakening. It's weakening, so it helps you to know when to enter, when to just stay away until the market tells you what it is actually trying to print. Yeah, hope they are not confused you. One after another, one after another. Okay. So like when you give this deeper correction, the market it just reached exactly 127.2 and it reversed. Yeah, and it even printed kangaroo tail. You can see that candlestick. Although it's not a very clear bearish kangaroo tail, but just the tail itself, the body remains bullish body, but the tail, okay, the tail is so long, showing us rejection of the price. So here, if you had already moved your that trade, just imagine if you had bought at this level here. You bought here, and then you placed your take profit somewhere, ignoring what you expected, ignoring what the market is telling you, only for the market to come, reach 127, and then it reverses. So it means you were so much in profit, only for you to lose all of it and probably close at a loss, because the market is still going down and down. So that is that means it's very important when you're placing your take profit. Don't just place them arbitrarily. Place them as the market's telling you. Yeah. So unless you see, okay, many times I always place at 127, but if I see the bulls are strong, if it's a trending market, you move it. You can always move it further. But there are scenarios where the market just jump, hit 127, and then it reverses at such a high speed. So if your take profit was so far away and you don't even have a chance to move it, then you lose all that profit you've already earned. Okay, so it's very important when you're placing your take profit. If the market makes a deeper correction, then it's better, weaker, new structure higher, new structure low. So be careful. If you have bought or you've sold, depending on the direction of the market, do not place your profit target very far. It's better weaker, new structure high or new structure low, depending on the direction of the market. All right? Did you get it? Any question? Any concerns? Because I know there must be a question with all these going round in circles with each other. Any question? You can also see how these extensions play out. If I can just remove everything and just show you exactly just about extension. Extensions are very key in placing your take profits. Make use of it, and then tomorrow we'll see about we'll see more about harmonics. How now they come and meet the ratios and they confirm to you the market will struggle to cross here, right? Especially when the harmonics are in line with the ratios, what we call the confluence. It is strengthened your expectations. Yeah. So like in this case, let's say I saw my please, if it's not clear, ask any question. I'm hoping you can, because this is the core of our analysis. This is what we'll use in our daily trading, right? Do your analysis, form expectation, then you trade as per expectation. Okay, let's say we saw this head and shoulder forming, okay? Inverse head and shoulder forming. And then we bought here. We bought here. So we use the extension of the previous swing, okay? So you're saying, you can see when the market hit 127, the market reversed. There is a struggle because we say this, the traders behave the same. Yeah? And all of us are expecting those ratios will play a big role in making traders make a decision whether to buy or to sell. Also, when you look to the other side there is also resistance. Yeah, there is resistance. And this is what we're going to see tomorrow, to come out tomorrow. When ratio is in line with some resistance zone. Yeah, if there are both of them in line, it means there is confluence. The resistance is strengthened, or that the expectation is strengthened. Okay, so if I drew my natural ratio and the extension tells me this is what 127 is, when I look to the left, there is resistance around that line. Okay. Remember we said it's a zone, so I will do my zone. It just, sorry, I don't know what it is this, refusing the shapes. Sorry about that. But even if I just do the line, you can actually see that there is some resistance here, which is in line with where extension 127 comes in. So it will be illogical for me to just put my take profit here. When I can see here, there is confluence ratio and resistance. Okay, so I would rather put my TP there. I put my TP there. Once it is hit, I will exit my profit, wait for the market to retrace, and get another opportunity to enter. But when the market is so strong, like you can see the first swing, oh, these are bulls. The second swing, another strong bulls. Then I can say, although the market is likely to face resistance at 127, what I will do, I'll only move my stop loss to lock in more profit. And because we're expecting a shallow correction, yeah, because we're expecting a shallow correction, what I usually do, I will put my TP at 61, all right? So my SL at 61. Let me show you what we're saying here. So we entered at this red arrow here, all right? Because the bulls are very strong, head and shoulder. So the right shoulder, I buy, okay? I see another strong move by the bulls. I'm like, these bulls, now they're at 127. It can reverse, but they look strong. So what I will do, the moment it makes a new structure high, I have to draw a new Fibonacci ratio from the previous low to the new structure high. Okay, because of the strength, when I look at the momentum and the projection, they are so strong. Okay, you can see this is the momentum here. Yeah, and then the second momentum here, they are just so steep. And then I look at the projection, yeah, using the projection, using the minor swings, okay, minor swings. It's also pretty big. Yeah, you can see that projection. This tells me the bulls are really coming in. So they are actually likely to break the 127. They are likely to break the 127. So what I will do, I will move my sell. Previously, when I bought, my sell was here. Yeah, my sell was here. The moment the market breaks this structure and it hits 127, I will move because I'm expecting a shallow correction. I will move my SL to somewhere at, sorry, where is this chart moving all of it? Sorry. So I move my SL at 50 or 61. I'm expecting a shallow correction. So I will lock my profit, but still give trade room to move up. Okay, giving my trade room to move more. So there are those, you just make those kind of bets. You look at those, they help you to know, so how close can I move myself to still allow my trade to continue playing out. So when I'm expecting a shallow correction, I ensure, and I can see the market is so strong, I will move myself to ensure, although I've locked in some profit, I still want to give my market my trade room, yeah, so that the market can be able to breathe and continue moving up, right? And actually, because market retraced to 38, based on the momentum and projection, we expected a shallow correction, which was attained at 38. So when the market retraced at 38, now we expect a bigger move up, right? But I still target 120. Market reached 127, it reversed again. So when it hits 127, I still move my SL again, right? So you try to balance all those three to manage your trade. I think there is a query or concern. Thank you, Jackie. What I will do, I will move my SL when the market reaches what we call strike. Okay. So if I bought here, just a second, let me reduce these lines to highlight this. If I bought here, You know, the market came up to this level, it retraced, it came up to this level, and then I bought. When the market crosses the previous new structure high, when it crosses, we call it structure, this level. When the market is crossing here at this point, the moment it crosses, I will move my SL to break even. Break even means I will just move it to where I bought my buying price plus a few pips. Yeah, so I can actually now lock in. When it has gone, it forms a new structure high. I move and lock in profit. When it hits 127, yeah, extension 127, I will move it further to lock in more. Because it's at those ratios where decisions are made. And now this is worse because that it's at an area of confluence. It's coinciding with resistance. So the market can actually reverse. So I will move my stop loss to lock in more profit, but still given on the strength of the bulls, I will ensure I'm not so much close to the market. I'm still giving it time to breathe. So when the market moves, it reaches 127, it retraces, and then it starts going up. The moment it crosses the new structure high here, again I move my SL to lock in more profit. Okay, so this is manual trailing. All right, so every time it crosses that new structure, or the new structure high, you move it. Okay, but give your market room to breathe. But when you notice the market is giving you signals of break of structure, okay, like here, what I'll do, there's this moment you just have to be the traders to be close, because it cannot just run in your direction forever. So when you see the market is slowing down, okay, like in this case, momentum was strong, the other momentum was strong, okay, projections were good. That is that projection. Remember, now we are already in trade. We're just analyzing to see how am I going to trade my trade to ensure I get the best out of this uptrending market. All right. So when you look at those projections there, this is the first one. This is the first one. This is the second one. Our projections, and then we still get our momentum. Look at this momentum here. Momentum, I can change color. I will make it what? Which one can you see clearly? The blue be visible? Can you see blue? Let's see. Yeah, momentum is in blue. Oh, which other color is so clear on a black? Let me check from screen. All right, let's use sky blue. Let's use aqua. That's aqua. Oh, retain it red. Red you can still see. I just wanted to use different colors for different, but because it's giving us some of these colors you may not see. Let's retain red. Because again, you know what is momentum is. It's from the low to high. So look at the first momentum. All right, I'll call it M1. I'll call it M1. That's our one, momentum 1. Then we have momentum 2. Okay, momentum 2. And then we also have momentum 3. Okay, momentum 3. M3. Remember, we say momentum is the peak, the anchor. How slanting is it? So the steeper is it is, the stronger the market is. So when you look at M1 is quite steep. It's almost like a vertical line. If I draw it nicely from the very top to the very bottom to the very top, it is like a straight vertical line. So the momentum is so strong. That tells me the bulls are so strong. Yeah, and that's why when it gave me, I saw it retraced so deep to give me that momentum, and I saw the market is now forming a head and shoulder. I entered at the right shoulder. Okay, Then I wait. The market crosses this line of a lower high. I move my SL. I lock in profit. Okay. I move it somewhere here. Okay. When the market moves, look at M2. M2 is a little bit more slanting than M1. Yeah. It means the both are, yes, in control. I can see so many bullish candlesticks, but they are not as strong as they were in M1. All right. Momentum is pretty good. Sorry, not momentum, but projection is pretty good. Depth, what depth did the market achieve? It achieved 50. Is it 50? Yes, it was 50. 50 is in the category of shallow correction. So that tells me the bears are not about coming, the bulls are running the show. Okay? So I will let my trade, I will not struggle. Yeah? I will not struggle my trade. I will give it room to play out. There's opportunity for me to pocket more pips. Okay? Then the market prints a new structure high, then it retraces. Okay? It retraces to a higher low. The depth, not so big. Let's see the new depth. The new depth is 38. That tells me the bulls are still in control. Okay? The depth is not so much. The bulls are still in control. I will let them play out. I still give my trade chance. So now we are on M3. The moment the market again crosses this area here, yeah, the new structure high, I move my SL, I can bring it to structure because there is no way the market will break this one unless it is reversing. So I know I'm still safe. Okay. But when you look at M3, when the market has come, it has reached this point here. It has made this new structure high here. Okay. I will draw my momentum and see the momentum is slanting a little bit more. Okay. So there's some struggle. Bears are coming in. That's why they are making it, one trader for bullish, another trader for bearish. It's like they both go up, they bring them down. That's what it means. That's why it gets a little bit more slanting. Because both try to go up, bears come in, they pull them down. So they take a longer time to attain a particular new structure high. And that makes and not as steep as the first one. Okay. So you can see it's telling us the market is weakening. Okay. Then I look at my projection. Projection has also become very small, all right, compared to the first one. So this is telling me this market, it may not reverse, but it might make a deeper correction. So when it's going from here, I will actually I will draw my Fibonacci, and I move it to somewhere at 61. My SL to 61 of the current Fibonacci. That is 61, all right? You see, the first move, I'm not knocked off. The market resumes. And then it comes down again. So eventually, I'll be taken out. Okay? But if I'm taken out here, and I can see the bears are really coming in, I may still enter because it's a 760. I might still re-enter with a buy. But the market is weakening. The market is weakening. At your second buy, you have to be careful that the market might reverse anytime. But the good thing is, you're entering at 76. Okay, you are buying at this level. Sorry, moving my stuff. I'm checking. It's refusing. So you've been taken out in your first in your first entry. A very good profit. So now you enter again here at 76. And you're saying, after all, what's the risk reward ratio? The risk is so small. Yeah, this is the risk I'm taking from here from my entry to my stop loss. Because stop loss should be below the zero. Yeah, below structure, below the structure. Your stop loss should be here. All right. So the risk is so small and it's worth taking, given where I'm expecting the market to move, because 127 is here. So look at this risk here versus the profit you are likely to make. This is the profit you are likely to make. Yeah, from where you've entered to 127. So that's a very good risk reward ratio. You're like, the market is weakening, yes, but it's giving me a signal. I will buy, but maybe enter at a small volume, few number of lots. because anything can happen. So that even if I'm taken out, I don't lose so much. Yeah, this is the loss I'm likely to take compared to the profit I'm likely to take. And again, the market plays in your favor, because you see, until the market breaks this new structure low here, we are still expecting a new structure high. All right. So you analyze combining all that to make your decisions. Okay. So the market printed a new structure high. So at this level, you can market is really struggling. Eh? So we expect anything. That's a higher low. And this is a new structure. This is a new structure high. New structure high. And the market has now retraced up to it's now at 76 again. Again, it gives you a signal you can still enter. All right, you can still enter, but you enter with low volumes, or rather few lots, smaller lot size, because the market is weakening. It's so clear the market is weakening. The bears are coming in. All right. You can also always go to the bigger time frame and see left side of the market, and for sure there's a lot of struggle. Okay, no wonder the market is struggling. Okay. Just trying to clear for it to be clear for you to see. So even the moment you buy, you can always go to the bigger time frame to see the zone to expect the market to struggle. Okay, like here it was already very clear there is some resistance here. You can see that. This is a resistance zone. It was initially support here. It became resistance. Now it's becoming our resistance again. We start, when you see all that playing together, and it also comes then with one of your ratios. When the market gets there, you just you move your stop loss more closer to the price. Okay? Oh, you can't hear me. Sorry, Marianne. Sorry. Hope I'm clear now. Okay, thank you. All right. So you can always look at the bigger time frames to see where your areas of support are, or areas of resistance, so that when the market gets there and you see it struggling, you can always move your stop loss to lock in more profit, so that in case it reverses, you don't lose so much. It's so painful for you to pocket like 100 points, and then because the TP was a little bit fine, you never lost profit, only to lose all of them and only get like 20. It's so painful. Yeah, so you have to be a little bit careful. When you see the market likely to reverse or to take a deeper correction, just take your profit and you can re-enter if it gives you another opportunity to re-enter. All right. So that's it about. So I also mentioned about so what the smaller swings. The smaller swings are what we call immediate order flow. Okay, immediate order flow, like the ones I'm drawing. So you can always trade them. Like this is in line with the main order flow. When you draw the main swing, that's a main order flow, okay? And then the smaller, the immediate order flow, which are in line with the main order flow, okay? And the order flow, it's that move from low to high. The yellow line is our main order flow, okay? It has moved from higher low to the new structure high. Then as the market goes through all this, now to make that you can always trade the smaller order flows as long, or the immediate order flows, as long as they are in line, in the same direction with the main order flow. Okay, so that's it. This bit of the analysis I find it enjoyable. Of course, sometimes not play out. You form an expectation, you enter, and the market doesn't play out. Maybe it only fails. The expectation fails when you've entered. Then you're like, was it only waiting for me to enter for it to reverse? Okay, so there are those kind of feelings at times. but it's okay. It's what it is, so we take it and move on. If it's a hit, you take a hit and have the next one works in your favor. So these are our main order flow, okay? Then there's something we call, before we leave here, although we'll cover that more tomorrow, how we compile ratios and harmonics. In harmonics, there's something we call 1:1 ratio. The market is expected to make equal moves in the same direction, okay? Such that when it makes this move, we expect the other one to be equal to that, okay? Because it has played out, yeah? So this is what we call 1:1 ratios. When the market starts to move, there is that expect when the market moves another equal move, then it's likely to make a deeper correction. Okay, take a deeper correction. And especially if that the second one it's in line with a ratio, an extension. Okay. And you can see 1:1 ends where 127 is. So when you do your charts and you see that kind of an occurrence, expect a deeper correction. Yeah. And sometimes people actually enter a short at the end of the second ratio, at the end of the next one. Okay. So you call it 1:1 or AB is equal to BC. Yeah. Some of you follow me on Facebook, you see, what is the benefit of the minor to the main order flow? The benefit is that you can actually enter more. You know, you are not sure it's going to play out. You are not sure it's going to achieve. Let me go there to show you something. The benefits of trading these minor ones, our expectation is for a new structure high. That's our expectation. We are not sure it's going to be achieved until it is achieved. Okay? So you can always enter and buy these ones. And also the depth, momentum, and the projection of the minor or rather immediate order flow can tell you whether the market is strengthening or weakening. Okay? So like if let's say you are trading the main order flow and then you bought here. Okay? You bought here this arrow. You are trading the main order flow and you bought here. You can actually use the smaller order frames or rather the immediate order flow. Immediate, you'll see maybe in some of the analysis they write just IOF. In Forex there is a lot of initialing, just using the short forms. IOF will stand for immediate order flow. Area of interest, AOI. And then you'll want all these things we're talking about, okay? So if you bought here, you can actually use the smaller order flows or immediate order flows to trail your trade, okay? You can always bring it to the next structure. Yeah? In the immediate order flow, it forms a new structure. When it crosses there, you move it there. You move your stop loss there. It makes a new structure high within the immediate order flow. It makes a higher low. When it crosses that new structure high, you move your stop loss to the next structure. So this helps you to track closely. So in case there's a breakdown, because before the main structure, the new structure high, before the main order flow is broken, it will first break the immediate order flow. Before it breaks the main order flow, before it comes and takes away here, because we will only, for us, we use the main order flow. And we will only see the market is reversing if it comes down and crosses this line. Where we have the higher low main swing. Yeah? But imagine now you have to wait all the way. But the moment it breaks the structure of the smaller order flow or immediate order flow, it's already a signal. The market is likely to break the main order flow also, all right? Although something can break through what we call complex correction, it can go all the directions. But many times, personally, if I'm not trading smaller order flows or the immediate order flows, I use them to trade if I'm already in the entry, okay? So when I move it there, and then once it goes above there, I move it there, all right? So when I'm tracing with that, then it means I'm able to lock in more profits before the market reverses. All right. So that's how I use it personally. That's how I use it. Okay. Any other question? So I was actually showing you how the ratios and harmonics work out. In harmonics, it's very wide. Harmonics, there's a whole book on harmonics by one Steve Carney. There's a lot, and many shapes. There's what we call crab, butterfly, yeah. There's a lot, but we've tried to, okay, personally, I've focused on that which helps us to enter the market early. Because when you look at the other shapes, the crabs and all that, it means you have to wait for the market to play a certain shape, which can take a longer time for it to form, okay? So I try to use the ones which just we can enter before the shape is completed, all right? I will still give you those notes for those shapes. It's also good to read because the shape can also form as you do your other analysis. Then you realize a crab is forming. Then you follow the rules of a crab. You realize a butterfly is forming. You follow the rules of a butterfly, okay? So I'll still give you those notes so that I may not cover in this class. Here we'll cover mostly what we call the ABCD. AB is equal to CD and 1:1 ratios, okay? Which are very easy to follow, okay? So we say like 1:1, you draw that, the market starts reversing again, or rather resume the original trend, you move the 1:1. So you expect the market to come and at least complete 1:1, okay? So when you draw your Fibonacci and that 1:1, it's in line with the ratio, one of the extensions. Chances are this market, when it reaches there, either it will make a deep correction or it's going to reverse. All right, so you can actually comfortably sell here, and that is when you trade against expectations, because you're saying the market has, there is a confluence here, a confluence of 1:1 and 127. So just the market either make a deep correction or reverse. So if you sell here, you will only, the moment the market reaches 38, actually correct, you can now lock your profit. But we'll do this selling against, or rather entering against expectation, okay? So because it attained 1:1 at ratio 127, we expect a deeper correction to come up to 1, okay? So we cannot enter until the market attains a deep correction. So all these just help us to form expectations, to know our areas of interest, where to wait for the market to come and for us to be able to enter, all right? But we cover now these ones more tomorrow. Today, just focus on the momentum, depth, and projection, and how we use them to form expectations and to know where to enter our trades. You can also, if you're comfortable enough, you can also place your painting order. In this case, we see you do your analysis, you're saying, based on our early analysis, which chart were we analyzing earlier? Well, what is it trying to say? When you're expecting a deeper correction, you can see I will only enter when the market reaches 61. Yeah, so you can just really place your painting order at 61, and then you put your profit at the right position. The only risk is if the market is not just reversing or correcting, but it's actually reversing. Yeah, because it means you reach 61, passes, goes to 76, passes, and then goes to knock your stop loss. But you can use this analysis based on your expectations for you to put painting orders. Although it's really not, it's still risky. It's risky because the market may not really just retrace, maybe reversing, and you never know when it is reversing. Okay, so I'm trying to wait for a signal candle, and before the end of the week we'll cover what are some of the signal candles to look for. But it is that one, what do I look for? Okay, like at 38, sorry, like if I was expecting a market to reverse up to 38, then I see that kind of strong bearish candlestick, then I would be like, I have to wait. It seems to be going further and further. Okay, reaches 50, I see this kind of rejection, this kind of tails, and when I look to the left, there's a lot of resistance there, so support there, so I can comfortably buy. So when I buy, my stop loss is at still down here. Yeah, but as soon as we cover psychology and risk management, that's why we look at more on risk reward ratios. Which trade, let them go, which trades you feel you have to take. Great. Any question? Sorry, we'll not cover this bit of supply and demand. I think in our training we've done so much of demand and supply, So I'm sure if you read those notes, you'll still get it. But not good for short time frames. Well, it is actually what I was showing there was a 5-minute time chart, and it was still playing out. It will work with every time frame, irrespective. It will work with whether it's 1 minute, whether it's actually like when I'm trading SP500, I use 1 minute, and I still use this analysis. Yeah. So it will work with any time frame, okay? So at your own time, please read supply and demand. It's all what we've been covering, nothing new, yeah? Just the same things we've been covering, but in case you get any question, please ask, all right? It's just the same things we've been covering, nothing new. So just read that portion at your own time, and then if you have any question, you can always ask. Any other question before we close for the day? So just try to identify those momentum. Hope you got it, guys. Because again, we are saying this now, this is our backbone of our analysis, our trading in this strategy. Then once you combine with the main ratios, the ABCD, 1:1, and the AB is equal to CD, then we see. I'm sure someone's wondering what is the difference between AB is equal to CD and ABCD. Those are very different. AB is equal to CD can be compared with 1:1. But ABCD pattern means completely different thing, which you are going to see tomorrow. Any question? Are we good? Did this sound is doable and very clear to identify all that? Any question? Are we more lost or are we seeing some light? You're good. You're good, Perfect. Okay, guys, you have a nice evening, but please ask questions, Ask question. But this will form our the core of our strategy, so you ensure you get it right, then you combine with the ratio, then you'll be good to go. Thank you for your time. Have a lovely